The abundance of strategies, indicators and patterns there are in the trading world can be confusing for even a seasoned professional. However, a wave of traders have ignored other strategies and focused on just one, the inner circle trader strategy. And it's taken the trading world by storm. Hi there and welcome back to the How to Trade YouTube channel. My name is Connor Woods and I'm one of the trading coaches here. The inner circle trader / ICT trading strategy is a comprehensive approach to trading that is based on analysing market structure. Now, what sets this strategy apart is its ability to shed light on the actions of institutional traders in the market. And in this video, I'm going to show you exactly how to do that. So let's dive in. The inner circle trading strategy, or the ICT strategy, is a methodology developed by a trader named Michael J. Huddleston. If you want to understand it, it's imperative that you can get to grips with the following concepts.
Number one, liquidity, often regarded as one of the most complex smart money concepts, but also the most important. It utilises a theory that pinpoints areas on the chart where orders are either sitting above or below, waiting to be collected. Buy-side liquidity refers to the area on a price chart where short selling traders are likely to have their stop orders placed. And conversely, sell-side liquidity identifies the zones where bullish traders' stop orders are concentrated. Number two, displacement. This is characterised by a sudden and forceful price movement, either up or down. On a price chart, it typically appears as a sequence of consecutive long candles with minimal wicks, all moving in the same direction. It signifies a sudden surge in buying or selling pressure, which frequently occurs when the price reaches a liquidity level. Additionally, displacement almost invariably results in two significant outcomes: a market structure shift and a fair value gap. Number three, market structure shift. One of the ICT basics, but very important. It identifies shifts in the market's overall trend. A break of structure is said to have taken place when the price sets a new high or a new low while breaking the former ones, just like this. Number four, inducement. Inducements are seen at the peaks of mini counter trends within a larger scale trend. And according to ICT, these movements are often the result of smart money engaging in stop loss hunting activities in lower time frames. Number five, fair value gaps, also referred to as FVGs. And they're a unique trading concept that occurs when the market moves quickly from one price level to another, often leaving gaps on price charts. This is common over the weekend or during a big news event. And finally, number six, order blocks. Some people also call them supply and demand zones, and this concept is fundamental to understanding ICT. Essentially, order blocks refer to a market condition when central banks, governments, and large financial institutions accumulate or distribute large quantities of an asset through several big orders. And then what happens is their footprint is left behind on the market as the last candle before that big move.
Now let's put this all together and find some trading examples.
Okay, so when it comes to trading the ICT trading strategy, there's three really simple steps we must follow. Those essentially are: number one, we wait for the liquidity sweep on the higher time frame. Now that for me would be the H4 or above, so 4-hour chart, maybe daily, weekly, or even monthly time frame. And then what we need to do is we need to wait for a reaction. Now, the best way to do that is the ICT way, which is waiting for a lower time frame change of character or break of structure. And if you check out the YouTube channel, we do have videos on each of those concepts. Then we just simply need to wait for a valid order block entry, and we set our entry at the beginning of that order block with our stop loss either below or above it, depending on what direction we're trading in. So if we just look at an example here, basically what I've got here is the New Zealand dollar US dollar time frame on the 4-hour. And if we zoom out on here, you can see what we're looking for is we're looking for liquidity sweeps on either the swing highs or the swing lows. So if I start down here, you can see that we have a successful sell side liquidity sweep at this low. Then what we need to do is dive down onto the lower time frame. So that can be the 1 hour, the 15 minute, 5 minute, 1 minute if you have to sort of find the one that you prefer. Now for me, I do like the 15 minute or the 5 minute time frame. So if I go down onto the 15 minute and I find where that liquidity sweep was, which is, that's the second one. First one was a bit further back, which is here. right? And this is what we would have been faced with when it comes to actually trying to trade this strategy. So what we wait for is a lower time frame, either change of character or change in structure. Now, if this was actually in the live prices, you could actually turn on this smart money concepts indicator and actually see if there's any change of character that it marks for you automatically, but you can't see it too far back. So let's just have a look at what we've got here. So if we look at the reaction from that liquidity sweep, we had a bit of a pause and then our next break high. So this is our sort of first change of character, should we say, here. Where that came from was this move in here, and you can see here's our order block. And if we place the buy after that break, little retest here. We always set our stop loss just below the order block if we're buying the market and just above it if we're selling. And you can see how much profit this trade actually went on to get before coming back. 14 to 1. So even if you just say you wanted to only target, say, 3 or 4 to 1 out of these trades, you'd have easily got that. And you actually probably would have got some more entries along as we sort of followed this trend higher. If you prefer as well, you don't have to go onto the lower time frames. You can stay on the higher time frames, but you just have to remain patient with it. So you can actually see that what we would have done here, for example, we'd have had another liquidity sweep on this low. We wait for a reaction. We probably get our first change of character here, maybe. But you can see that sometimes the downside to keeping it on the higher time frames is that you don't actually get filled in your order, which if you went down on the lower time frames, you probably would have been able to find one. However, sometimes the benefit is if you do wait for the lower time frame, the higher time frames, you can see you can get the actual reversal. Now the same would apply if you was trading it on the if you was trading buy side liquidity. Again, look at that. There's our swing high, buy side liquidity taken. Look at that trend reversal. If we go down onto the 15 or 5 minute time frame, we'll see if we can find an entry. It's quite a big rally there. Maybe, and if you can't find an entry on, say, the 15 minute, just keep dropping down as soon as, and you're just really looking for a time when there's the clearest lower time frame order block. That's basically what we're looking for. I can't actually go onto the 15 minute, it doesn't let me go that far, but the concept is still the same. All we have to do is get that liquidity sweep in the higher time frame. We then use the lower time frame to look for changes of character or breaks of structure, and then we simply wait for an entry on the order block, and you can see how powerful that can be.
Now, as we draw this deep dive into the ICT trading strategy to a close, the burning question does remain: is it truly a profitable strategy? Now, this is of course down to personal preference, but the key strength of it is its attempt to mimic the trading behaviour of smart money, i.e. the institutional players in the market. And by strategically putting your orders at levels where retail traders' stop losses are, you can help not be one of those 80% of retail traders that lose. So overall, this insight into smart money's moves can be a significant advantage to your trading. Do not forget to subscribe and hit that notification icon so you never miss out on future content. There is also a link to an article on this in the description below. Thank you for watching and happy trading.